Welcome to Whitefield Industrials half-year results update for the 6 months ending 30th of September 2023. I'm Monica Knight, and today I'll be talking with Managing Director Angus Gluskie and Director Will Seddon. This is the 101st year of the company's operation, and Whitefield's pleased to continue to offer investors a diversified and efficient exposure to Australian industrial shares. And Angus, with this in mind, let's turn to the company's earnings for the 6 months to September 2023. Earnings per ordinary share for the half year rose to 8.3 cents, having grown from 7.4 cents in the equivalent half of the prior year.
Yes, pleasingly, earnings growth in the half was particularly strong. We were encouraged to see dividend increases coming from a majority of holdings in the investment portfolio, and that translated to earnings per share growth of 12.2%. For the half year compared to the equivalent half in the prior year. Notable increases in that period could be seen from holdings such as car sales, WiseTech, AGL and Pro Medicus, from the insurers such as QBE, IAG and Suncorp, and also from financial stocks such as Macquarie Group and Computershare.
So in part, that reflected a continued bounce back in earnings on investments that had been affected by the COVID lockdowns?
That's right. Due to APRA restrictions, insurers were restricted in their ability to pay dividends during the COVID era, but more recently they've been able to restore their dividends towards more normalised levels. In addition, it's worth remembering that economic activity and growth has been more resilient than many people expected, and that's allowed earnings growth to come through in a range of other industry sectors as well.
And with regard to Whitefield's own dividends to shareholders, the company's declared half-year dividends of 10.25 cents per ordinary share and 131.25 cents per preference share. All dividends are fully franked and will be paid in mid-December. Angus, can you comment on the dividend outlook for the full year?
Yes, at this time we're expecting to retain the full year dividend, which is payable in June 2024, at the same levels as the dividends we've just paid. Our dividend at these levels broadly reflects our underlying net profit, as well as the average level of realised capital gains. Importantly, this does position us as we go forward through 2024 to start to consider the possibility of increasing dividends in future periods. And our considerations in that regard do depend, though, on the state of investment markets and our underlying earnings growth and economic activity in those years.
And Will, the half year to September saw equity markets, including Australia, remain relatively flat. Can you comment on that environment?
Sure. Over the period, investment markets have been dominated by the outlook for inflation and interest rates, along with continuing geopolitical tensions. While inflation around the world has continued to retreat, supporting equity returns, gains have been tempered by disappointment around the speed with which inflation has eased.
So in that environment, Whitefield's portfolio generated a return of 0.91% for the half year. Can you explain which holdings were the primary contributors to that result?
The banks and insurers were moderate contributors in dollar terms. Several companies delivering strong dividend increases also generated strength of total return, and these included AGL, Pro Medicus, car sales and Computershare. And notable contributions also came from technology businesses such as NextDC, Megaport, Life360 and Telix Pharmaceuticals.
Have investors seen the worst of this inflation shock?
Well, the global supply chain pressures of 2021-22 have eased, and that's translating into a softer inflation across a range of imported goods in particular. Very low inflation in China, which is one of the world's largest exporters, has assisted as well. Nevertheless, continuing geopolitical and military tensions and trade disputes are likely to remain a feature of the economic landscape for some time, having the potential to push costs of production higher. In addition, many consumers are grappling with high housing costs, higher interest rates, and a widespread increase in the cost of living. In this situation, it's likely consumers will ask for higher wages, and businesses, in turn, will attempt to pass this on through higher prices of goods and services.
How is Whitefield's portfolio positioned for that outlook?
We continue to believe that higher quality businesses with strong competitive positions will be less adversely affected by higher inflation and interest rates. and would still benefit should inflationary expectations be lowered. Accordingly, our portfolio gives some weighting towards businesses rating favourably on our quality metrics. The resilience of the Australian and global economies in absorbing the higher level of interest rates has surprised many investors and economists. And this has created some opportunities for strength of investment return by investing in the previously less favoured consumer and property sectors.
Over recent years, there's been much discussion about the listed investment company, or LIC structure. Angus, can you explain the reasons behind the structure of a listed investment company?
So sure, the LIC structure is designed to provide the benefits of durability as well as structural cost efficiency. Because LICs have a relatively stable capital and they don't face regular inflows and outflows such as open-end funds such as ETFs and unlisted managed funds face, they can make some cost savings through that stability. In particular, they can avoid the transaction and hedging costs associated with the repeat buying and selling of investments to handle or accommodate those inflows and outflows. And they also avoid the regular subtraction of value that occurs, for example, in ETFs due to ETF market makers taking a margin from buyers and sellers. LICs also avoid some of the risks associated with large inflows and outflows, and those risks include the risks of return dilution from inflows and the risks of loss or tax liability amplification that can occur with outflows. When it comes to the benefits of durability, LICs do provide the benefits of a long-term mindset or a long-term investment management mindset, as well as the corporate governance oversight that comes from a committed board of directors.
A LIC also provides investors with the convenience of buying and selling shares via ASX. That's the same as any other ASX listed share, isn't it?
Yes, it's very similar. Investors in listed investment companies typically use many of the strategies adopted by investors in shares generally. These simple strategies often reflect good common sense. Examples include just buying, selling and holding shares sensibly, patiently and reasonably, as well as investing for the long term, which can maximise the periods of time over which an investor can benefit from having acquired shares advantageously, as well as maximising the periods of time over which an investor can choose to conduct their transactions.
And finally, one of the interesting elements of a LIC is that because price varies over time, investors occasionally get the opportunity to acquire shares at attractive prices relative to asset backing. Can you explain how that can benefit an investor?
Sure, if you occasionally have the opportunity to acquire a LIC share at a price that's favourable or less than the asset backing of the share, then that can be a material and enduring benefit for the investor. The core nature of that benefit is that the investor has acquired an investment portfolio that's larger than the price that they've paid, and that will generate a benefit for them over many future years. To provide an example of that benefit, if an investor was able to acquire a listed investment company share for $1 at a point where the net asset value was $1.05, well, they're benefiting from a 5% larger investment portfolio generating investment returns for them. And this would mean that for every 10% of investment return generated by that larger investment portfolio over future years, that would translate to a 10.5% return for the investor themselves. And I think it's the enduring nature of that benefit, the fact that it goes on for as long as the investor holds that share, is perhaps the overlooked part of the equation.
Thanks for that. This brings us to the end of our September 23 half-year update. For more information on Whitefield, visit our website at whitefield.com.au.